Welcome back to Seafried and Brew's weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to look at interest rates, and we want to look at the projection or forecast of interest rates throughout the next year. So it's going to be a kind of an interesting look here. But before we go into the future, let's look into the past a little bit. Let's go back to the Treasury curve. Where the day before the Fed started their tightening strategy here, we can see pretty steep yield curve, and this is where we were the day before the Fed started tightening. As you know, on the 16th of December 2015, they started that tightening process, increased the range from 0 to 0.25, from 0.25 to 0.5, and then they waited a year, and then they started once again with their rate increases. But when we look at this and we flip over to where we are, or where we were at the first quarter 2017, you can see the short end of the curve has been affected by that lift in Fed funds. However, the long end of the curve here for the Treasuries had some upward momentum, but not as much as the short end. So we're still seeing that pressure holding down on that long end of the curve. Now, as you know, as the Fed moved in June, we picked up another 25 basis points. So we flip forward to the 10th of August here, and we can see 1 month Treasury at that 1%. Now, this is interesting how the long end of the curve moved between the end of March and August. We actually saw a fallback or a pullback in those rates. And now we're down to that 10-year at a 2.2 on August 10th, 2017, compared to the 2.4 where we were on March 31st. And then in December, if you recall, that 10-year got up to a 260 level. So we saw this shift, this non-parallel move in the yield curve. And in fact, we saw the slope of the curve come in here. This is where we've been. We're coming up to this point. We were hoping that we would see this long end of the curve move up as well, benefit us on the asset side of the equation for those longer assets. But that has yet to happen here. However, those banks that have those adjustable rates that are in that time to adjust, they're seeing that benefit in here. Flip this then into the future. We could look at the forward curve, the spot curve as of the 11th of August here. You can see this dashed blue line. And then we look at 6 months out with the green dotted line, and then that solid light blue line would be 1 year out, going out to August 11th of 2018. And what you see is a continual shift in the short end of the curve, and we see this moving up faster than the long end of the curve. So we see this non-parallel shift continuing to occur inside the forward curve. So that means a continued tightening of that spread between the 10-year and the 2-year Treasury, which then correlates to a narrowing of the net interest margin overall. That's what we have with that forward curve. So this is the spot curve, doing some bootstrapping, pulling out some of the rates into the forward curve. You can get this on your Bloomberg terminal at FWCV. Let's look at the economist now. So we're step away from the mathematical equations for the current curve and then projecting forward. And let's look what the economists are saying. We have where we were at the end of the second quarter, and then the projections out to the end of 2018. And you can see in here the spread, a 10-year, 2-year, continues to come down. The movements are a little different inside the different rates, but the overall spread of that, or a slope of the yield curve, continues to come down, so that continuing that non-parallel movement inside of rates. Again, not a good story for the bank's net interest margins. As we start to see this come back down, we're going to potentially see that net interest margin come down. We reported last week where we saw an increase in the net interest margin quarter over quarter. However, we questioned if that was going to be sustained into the future, and this would suggest that that is not going to be sustained, that that might be an anomaly for right now, and we're going to start to see that net interest margin pull back down. We move from the projections here of the overall rates in the market, and we look at the implied probabilities of the ultra short term or the Fed funds rate. As you know, the Fed came out and they said that most likely in the near future, suggesting potentially that in September they will begin that balance sheet unwind. And because of that, and because of the economic numbers that have been coming out, we see this push off in the next rate hike for the Fed. In fact, when we look at the implied probabilities, we can see there's the greatest probability even out toward going out toward April or May of 2018 that the Fed will not move. This continues to get pushed out. Just a couple of weeks ago, this would have been March, and now we got that 54.7% probability that the rate on the Fed funds will still be 1 to 1.25 going out to May of 2018. So there's something to keep an eye on. In fact, if you drop even down, 44% probability in June, greater than the 1.25 to 1.5 range. So we're continuing to see this push out of when the Fed's going to move next. This could be a benefit for banks because we see our deposit pricing not have that pressure to move up. However, when we look at the CD prices, if you recall last week when we went over the mix of cash type deposits, the total deposits, we saw it peak out and then come down for the last quarter. So we saw this leveling off, which is something that hasn't occurred over the past couple of years. So that could be, and I mentioned that could be the potential for depositors' appetite now moving toward CDs. So we look at the CD market in here, average national CD rates, these rates taken from S&L. So when you look at the S&L rates, this is for 8/8/2017, you can see the one-year rate at 54 basis points and where we were at the end of the first quarter at 48 basis points. So seeing that shift up a little bit, but it is a pickup in those rates. However, when we look at the bankrate.com rates and where they're showing the national average on that 1 year at a 141, their best rate they put out there at a 160. So you see that upward momentum. These are the special rates, the promotions that are going on for that 1 year. So this is kind of what your depositors are seeing here in the market when they're looking. So some interesting numbers here. You look at the 2-year rate at that 161, the best rate at that 181. Now, if we start to see our depositors move from those cash type deposits into the CDs, that's just going to exacerbate that movement in your cost of funds. And you're going to go from the rates of 0.5 to or 0.5 or even 0.1 up to these higher rates close to 1%, increasing that cost of funds, reducing down that net interest margin. So that's where the CD rates are today in the market, the most current information that we have. When we look out into the future, ultimately what we see, and everything's projecting to that narrowing of the yield curve, that could potentially be eroding our net interest margin. That coupled with the idea that the depositors' Appetite may be moving to longer term products or CDs, and that in effect could increase our cost of funds, further eroding our net interest margin. All the while, we are not getting any relief on the long end of the curve to support a higher yields out there for our assets. Unfortunately, I wish I could bring you better news, but that's where we are today. It's something to keep abreast on, something to keep in mind, and we will continue to look at this situation as we move through the quarter and we visit our banks in the ALCO meetings that we attend. We thank you very much for joining us, and we'll see you back here next week. Have a great week.